What happens when a nation's financial lifeline is entrusted to the very hands that cause the crisis? That's the core issue at play in Bangladesh's proposed merger of 5 struggling Islamic banks. And Fahmida Khatun, Executive Director of the Center for Policy Dialogue, CPD, and Bangladesh Bank board member, has laid out a stark warning. Without independent, professionally qualified directors, this plan is doomed to fail. But here's where it gets controversial. How can we trust a system that's already been compromised to fix itself? Let's unpack the stakes. The government's plan to merge First Security Islami Bank, Global Islami Bank, Union Bank, Social Islami Bank, and EXIM Bank aims to avert a systemic collapse. But Fahmida raises a critical question. Why should taxpayers foot the bill for banks that failed due to corruption and political favoritism? Imagine this. Depositors panic, businesses freeze, and employees lose jobs. Yet the same powerful interests that looted the banks will likely escape accountability. This isn't just a financial fix, it's a moral hazard. The government must ensure that those receiving bailouts are held strictly accountable, or the public's trust will crumble faster than the banks themselves. Who ensures political business interests do not capture the new board? That's the part most people miss. Historically, Bangladesh Bank's governance was weakened by political interference, allowing questionable loans to be approved and rescheduled with alarming ease. Without a strong, independent central bank, the merged entity risks becoming another puppet for the same corrupt networks. Think of it like trying to rebuild a house of cards while the wind is blowing. Without structural reforms, the foundation is doomed. Can the banking sector truly revive without overhauling Bangladesh Bank's governance? Fahmida argues it's impossible. The regulator itself must be freed from political influence. If the central bank isn't capable of enforcing rules, how can it expect banks to follow them? This isn't just about appointing new directors. It's about dismantling a culture of complacency that allowed the crisis to fester. Now, let's talk about the numbers. The government plans to inject 20,000 crore into the merger. But Bangladesh's fiscal space is already stretched thin. Last year, tax revenue accounted for just 7.4% of GDP, a figure far below what's needed to fund essential services like healthcare, education, and climate resilience. Allocating this massive sum to banks means tough choices. Will social programs suffer? Will climate adaptation projects be delayed? The government must promise this isn't a recurring cycle of bailouts. Past recapitalizations failed to address root causes. And without accountability, the money will simply prop up a broken system. Here's the catch. The opportunity cost is staggering. Every Tedo-1 spent on bank bailouts is a Tedo-1 not spent on building schools, hospitals, or flood barriers. Fahmida's critique isn't just about financial reform, it's about societal priorities. Should a regulator be held accountable if it allowed such practices in the first place? And if the central bank's independence is restored, can it truly act as a neutral arbiter? Or will it always be swayed by political tides? We'd love to hear your thoughts. Is this a necessary sacrifice for financial stability? Or are we simply repeating history with a new set of players? Should the government prioritize social infrastructure over bank recapitalizations, even if it risks short-term instability? Share your perspective in the comments. This isn't just a policy debate. It's a question of who truly benefits from Bangladesh's financial reforms.